Hello, everybody. This is Alan Ellman, the Blue Collar Investor, welcoming you to this BCI podcast number 125, titled Using Delta to Create Low Risk, High Reward Put Selling Trades. We're going to be using a real life example with Etsy Inc., which trades and is listed on the NASDAQ exchange under the ticker symbol ETSY. Now, when we sell cash secured puts in the BCI methodology, we look for strikes that are based on our initial time value return goal range and our personal risk tolerance. So one particular strike is not appropriate for every single investor. We have to define what our goal is, and we also must understand what our personal risk tolerance is. Now, in our BCI methodology, we use pretty much only out of the money cash secured puts. The only exception is if our objective is to purchase a stock at a discount and have those shares put to us sooner rather than later. But that's an exception to the rule in the BCI methodology. So let's assume that 98+% of the time, we're going to be using out of the money put strikes, which is lower than current market value. Now, there are times when market conditions are so volatile, so bearish, that we want to make extreme defensive positions in our portfolios rather than more traditional ones. So in other words, we're going to accept lower premiums in return for having more insurance to the downside. Now, this is the approach that I took after initiation of the COVID-19 crisis in early 2020, actually in March of 2020. So here's the defensive put selling strategy that I developed. We're going to select elite performing stocks or ETFs based on fundamental, technical, and common sense parameters. That is no different than traditional selling of cash secured puts. But then instead of looking for simply out of the money puts, we're going to be looking for extremely deep out of the money puts, way lower than current market value, that have deltas of 10 or less. Now for puts, delta is assigned a negative figure, so it's a -10, and that's because put prices are inversely related to that of the underlying security. So when I say a delta of 10 for puts, it's actually a -10. Now, in this particular example, we're going to be using weekly puts for Etsy with a target annualized return of somewhere between 10 and 15%. Now, that is still significant compared to other types of investments like CDs and money markets, treasuries, etc., as it was in 2020, even through 2021 as well. And this is going to be based on our initial time value return range. You could use monthlies as well, but in this particular example, we're going to be use weekly options. Many investors feel that the annualized return on weeklies will be slightly higher than that of using monthlies. Now, delta can be defined in several ways. The way it's defined in this particular podcast for this particular strategy is that it's the approximate percent probability that the option will expire in the money, or stated differently, with intrinsic value. So in other words, if we have a trade with a delta of 10, that means there's a 90% probability that that option will not be exercised. And so that's the starting point and the basis of this particular strategy. Now, for those of you that are also watching this podcast, I'm showing a chart of Etsy on 12/14/2020. And for those just listening, I will describe the chart to you. On the top, we have the 20-day and 100-day exponential moving averages, which is a very bullish parameter, showing an uptrending chart with the 20-day above the 100-day and the price bars at or above the 20-day EMA, very bullish. Now, below that, we have the MACD histogram, the blue bars, which are above zero. That's a trend and momentum indicator and also a bullish signal. Below that is the stochastic oscillator, another momentum indicator, also ascending, even though it's in an overbought position. We've seen those types of stocks remain overbought for months at a time. So also a bullish signal, and all of that occurred at the very bottom. You see average volume, so volume is not declining. Our rocket ship heading to the moon is not running out of fuel. Okay, so we have a technically very strong security. Now let's go to an option chain for Etsy on 12/14/2020, looking for the 1 week 12/18/2020 expiration. So Monday to Friday. At the time, Etsy was trading at 170.09, and we're going to look at the deep out of the money put strikes much lower than 170.09. We're going to focus in on two strikes. The 150 strike had a delta, you can look in the purple cells if you're watching this podcast, of 5. So a delta of 5 means there's a 95% probability that the option will not be exercised. That's approximate, it's not precise. And then the 152 deep out of the money put had a delta of 8, making it a 92% probability. So you could see the bid prices are 31 cents for the 150 put and 44 cents for the 152 put. Now we'll put this information into the white cells of the BCI Elite Put Selling Calculator. And those cells, the white cells, are at the top of the spreadsheet. And we enter the price of Etsy 170.09 for both. They both expire on Friday, 12/18. And the 150 strike had a 31 premium, 31 cents. The 152 strike had a premium of 44 cents. And the spreadsheet tells us that the annualized return on the 150 put was 15.12%. And that's the one that had a 95% probability of not being exercised. Now, if we go over to the 152.50 put with the delta of 8, the one I probably would have selected, and it had a premium of 44 cents, that resulted in an annualized return of 21.12% with a 90% probability of not getting exercised. Both of them are great choices with outstanding annualized returns and a huge amount of protection to the downside. Let's summarize. Significant annualized returns can be realized by using an ultra-conservative put weekly selling strategy, could also be monthly, where delta will allow us to create a low-risk, high-return strategies. Now, we must keep in mind, folks, that this is a low-risk, not a no-risk strategy, so we must be prepared at all times to implement our position management arsenal, which must be mastered prior to entering all of these trades. Now, information on these strategies, plus all covered call strategies, can be found in one place at a 25% reduced price using our BCI package, which has 18 components to it. 6 online video courses with downloadable workbooks, 6 calculators developed by the blue-collar investor and therefore located nowhere else, 5 of our best-selling books, both on covered call writing and selling cash secured puts and related strategies in ebook format, and 13 months of our annualized premium membership, which has a huge amount of components to it as well, including 4 reports of eligible stocks and ETFs for option selling, expanded calculators, and a few dozen other files and resources, and our online ongoing and never-ending video training, where we have right now over 200 training videos, including a full library of Ask Alan videos where we break down trades either from my portfolios or from that of our members. We have our in-depth Blue Hour webinar series, and we add 1 new training video to the member site every single month, some months too. More information on the BCI package can be found at our website, www.thebluecollarinvestor.com, and just click on the link at the top that says BCI package for more information. Now, you can also purchase items individually go to our store at www.thebluecollarinvestor.com/store. Folks, I want to thank you very, very much for taking the time to listen to and or watch this BCI podcast number 125, using Delta to create low risk, high reward put selling trades. Folks, I hope you enjoyed this presentation, and most importantly, I hope it puts cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.